What's going on, everybody? It's been a while. I haven't been on the show, and this guy hasn't been on the show for a while. What's going on, Chaim? It's been a while. How's life treating you?
I'm having a good time these days.
Good time. Good time is good. I think everybody right now is pretty bored with the markets as traders. Nothing's really going on right now. But today we're going to be talking about fintech, guys. I don't think we covered this. We haven't covered it in a while. Actually, it's a lot been about Wall Street Jesus that we brought in, the Rabbi of Wall Street. We got this whole like crazy thing going on, but we haven't touched about fintech in a while. And something that is always interesting. Obviously, from our perspective, it's like a cultural thing. A buy-side firm versus a sell-side firm. I'm wearing T-shirts and sweats when you see some Wall Streeters wearing their suits. But there's a little more depth to it, And Chaim, I believe you've been on both sides. So what?
Been everywhere.
Yeah, tell us about. Well, let's since you started sell side, right? So why don't we go ahead and just kind of think about what was on that sell side?
Yeah, well, I think it's interesting. I started market making, which was thought of traditionally as kind of ultra sell side, as far away. In the early days, as an electronic options market maker, it was actually illegal for you to see a customer order directly. You had to actually only interact with those orders on the exchange. So there was a regulatory wall, sometimes known as Chinese walls after the Great Wall of China, but that divided our activity from the rest of the world. So we didn't see the rest of the world. There were, of course, people who specialized in managing businesses that both, we used to say it was over the wall, but they would manage two businesses. One that it was market making business, and maybe another one that was an executing business. And so that's the first distinction we should probably talk about, is that there are market makers out there who take the other side of your trade, and there are brokers out there that will execute customer orders. And at
Sure.
times, in the options space, they actually have to be divided, but one firm can do both functions, and then you have to ask this. There's an interesting question of how do those two entities interact in the same
Yeah.
firm,
Sure.
because the regulatory wall between them. In the stock world, those entities are actually allowed to be commingled
Hmm.
within one entity, so the dealer can also be your broker.
So
And
that can be a cause for some concern for some
because
traders, right?
significant conflicts of interest in those types of functions. So what you'll see actually, and I think we've talked about this in other segments, but that we have upstairs market makers, sometimes known as internalizers or wholesalers. These, I'm thinking more of the larger market makers would be classified as that. And what they do is they will buy wholesale, let's say, um, significant amounts of order flow from retail brokers. Your Schwab, your TD Ameritrade, and they will execute those orders either by trading against them in the function of a dealer or market maker, or
Yeah.
they will decide, to route them
Brought it out. Yeah.
away as an agency broker. So they're actually doing both functions, being your agency broker and your market maker, and they decide order by order which one they want to be.
Sure. Got it. And and that's the sell side in terms of. So tell us about how about the P&Ls of a sell side when they have those capabilities. Like, is it tough to see profitable days every day? Like, why and how are they profitable so much? We hear about sell side firms, market makers that never lose money, or because they have customer flow that they can sustain a certain humming of P&L at all times. Can you tell us a little bit about that in your experience?
Yeah, I mean, the space has been under significant compression. One of the biggest wholesalers out there, Knight Capital, I just tweeted, yesterday that they've been having a prolonged, significant period of decreased revenues and all that. You also hear about other firms, as you pointed out, that have had remarkably strong um, showing, and a firm like Virtue would be classified as that. Now, Virtue actually is a market maker, but has not been significantly involved in these order flow businesses.
Huh.
Although I'm sure they have order flow relationships, they just don't have the same type of presence in the order flow business that a Knight does. From what I remember, I believe that they actually made a bid for Knight, and got Knight instead of Virtue. So what you're seeing right now is the kind of golden days are over, but way back in time, um, having captive order flow that you could internalize and trade, directly against the dummies was incredibly lucrative, and that's how these firms, got into their positions in the market.
Sure, sure. So not only on the order flow side stuff, but a sell side, usually we think of like banks, right? They have a wealth management business, and then they may have a market making business. So they're subsidized for a lot of this technology. Tell us a little bit about like sell side technology. Was it bulky? Was it outrageous? I mean, you've had.
Yeah, well, I mean, and the sell side. I'm talking about the sell side mostly in the context of our space as traders, right? This general term, goes all the way out into the investment banking world, and generally, the difference between buy side and sell side is buy side are asset managers and money managers who purchase and hold securities, and sell side, traditionally meant the dealer who sold to the buy side, or who assisted in the creation of the products or the research. So sell side also covers the research offering, and within an investment bank, those functions are actually siloed into different divisions, and the interactions actually between those are heavily controlled. You can imagine working in a major investment bank. If you're a market maker, your interactions with the investment banking division
zero.
Well, you can have them, but they're very highly controlled. So you'd be surprised at how the technology is actually siloed into these different divisions, and there's not a lot of overlap actually.
Sure.
But within a division, you can have all sorts of interesting businesses, over-the-counter. In my space, in the derivative space, over-the-counter derivatives would use the same technology, let's say an options market maker, and there was actually a lot of overlap in communication, and it's particularly actually overseas where warrant businesses, Germany, Hong Kong, and all that, were actually quite retail businesses and had a lot of overlap with the listed options space. So, generally, just giving you kind of a color is yes, banks have a ton of technology, a ton of spend, and there's a lot of assets there. But one thing you don't see is you don't see the attention to detail and the nimbleness that, let's say, a high-frequency trading firm has. And these firms, I see as being almost on the other end of the spectrum from the banks.
Sure, sure. So that drops us right into the buy side, right? So these high frequency trading firms, I guess, I'm not 100% versed here, but so Volcker rule came out, and you had prop that had to get away from the banks, right? That prop trading side. I'm assuming, is this the same type of prop that kind of spun off into these little entities that were really, really powerful and really, really smart? Or is this just like separately formed, almost like startup types that come?
Yeah, well, no, to understand it, and things get very interesting because the term buy side now is, and we'll talk about it specifically in regard to high frequency trading, where it gets quite strange. But we'll talk about the Volcker rule. What happened to the Volcker rule is we had the major banks had basically these prop arms that were actually separate divisions, and you can think of them as sometimes they were connected to the asset management division.
Yep.
But the important thing to understand about them is that they basically were able to use the financing of the very low cost financing that a bank can provide to finance very, very large proprietary trading operations, and they tended to be capital intensive. Right now, if you compare that to a high frequency trading firm, you may have read or heard high frequency trading firms in general spend a lot of money on tech, but actually don't need a lot of capital for investment.
Right.
right? So the HFT space is actually quite different from the prop space. Now, where does it overlap? Well, there are major funds which engage in both. Citadel Investments would be a great example, where they have very large prop units and they have market making and HFT units, and both you'll see the press speak about those units tend to get in the news every now and then for various things.
Sure.
So
but market making and prop trading are different, though, right? Those are
and let's talk about the last part of the vocal rule here, just for everyone's kind of general information, is that there was specific language in the vocal rule that tried to carve out and say, we don't want the vocal rule to interfere with liquidity, so we want to protect market making within the banks. We want to keep banks acting like dealers and intermediaries. We just want to stop them from taking, incredibly large risk on mortgage-backed securities and things like that could make another 2008 financial crisis. So, so I think, but another thing, angle there to understand is that there were some very large quantitative trading operations within those prop units, and those were more of the statistical arbitrage kind of structure. A number of them were spun out over the last 5 years. So I won't name them, but very famous groups were spun out, and maybe they didn't even have to be forced to be. Maybe it wasn't that they were forced out, but the environment was such that it made sense for the banks to divest of those units. So let's bring it back to the HFT stuff now. Okay, so HFTs, are what happened with the HFT business is kind of occurred in parallel over the financial crisis. It actually didn't have much to do with the financial crisis, in my opinion. But the stress that was on the banks did actually create an environment where HFTs who didn't have those stresses, could
businesses,
could they had a period of time where they could grow, and also the banks, this is one of the businesses where banks still got a lot of clearing revenue from, and they were low risk. So banks really actually liked these businesses and supported them. Now the HFTs, many of the firms were basically firms that ran strategies, and they started out running the strategies as without broker-dealer status. So they're a customer. They're a buy side. Many of the firms didn't want the overhead of the to begin with, and the cost of running a broker-dealer. But later on, and this is my personal opinion, many of them avoided broker-dealer status because they didn't want the regulatory scrutiny. And you may have heard that there's lots and lots of activities that HFT has been engaged in. Latency arbitrage is one of the more famous ones. Those are the type of activities that you wouldn't want a lot of scrutiny on, and you wouldn't, for example, want to become
a broker-dealer. Because you have risk checks that you have to be able to submit to, and all that oaths reporting, all that type of stuff. That's all required, which is just that much more headache. But also, isn't there a little bit of fee structure involved with either becoming a broker-dealer or a regular customer and all that?
In the options space, yes, actually. In the options space, the type of participant you are will have a different type of fee. And I think we talked about this in the options space in the all the way up till about 2010. There was a breed of market maker that would take advantage of the zero fees that were provided to regular retail customers and run these high volume strategies where they were trading for free under a customer account. And one firm actually achieved 5% of the U.S. options market, having all these day traders kind of come into their system. And the day traders weren't your standard day traders. They were basically old school floor traders. We're just running the same type of strategies through the system. Okay, so what are we getting at here? These types of operations are basically, and right now, as you know, HFT is about half of the volume in the United States stock market. These firms, basically took away the primary sell side function of
Oh yeah.
intermediation,
Sure. Yep.
right? And they said, hey, it's so much better being a market maker on the buy side
Yeah.
than being a market maker on the sell side. So that's why I kind of said at the beginning of the conversation that being a market maker is actually quite, I don't even think of it as buy side or sell side. I think of it as like almost the third dimension of this problem.
Yeah. Yeah. Totally.
Okay. And that's
So,
where you guys are, right?
yep, it's technically where we are. Yep, exactly. So, what about the infrastructure that a buy-side firm has? Like, I'm sure you've talked to plenty of buy-side high-frequency trading firms. Um, I mean, I'm assuming they're much lower in cost compared to the sell side. But what about like the innovation that they have versus the sell side? Is there something different there? Are they doing better things? Does it look like overall it's more intelligent? Obviously, we're not trying to get you to talk smack about sell side because we're buy side, but I just want to kind of hear like your experiences and what you've seen out there.
Well, I mean, in terms of firms that are truly innovative, I mean, the ones that would classify as truly innovative are really the large quantitative trading operations, hedge funds that have been in business for over 20 years,
Mm-hmm.
and I see those as an entirely different class of entity
Yeah,
than these firms that kind of were brought up in the technology age.
right. They're
Uh,
less high frequency though, right? Those big ones.
Yeah, I would also argue many of them provide probably way more, much more liquidity in terms of risk tolerance, of course.
Of course.
Okay,
Yeah.
but they take the other side of trades, and they are central to the we call it the risk transfer operation of the market. So I have a lot of respect for those firms. So you talked about innovation. I think that's where the innovation is.
Mm.
Um, in the market structure space, which is kind of where the HFTs operate, I'm just kind of cynical calling it innovation. I mean, yeah, they're very good at finding creative ways to make money, but often the techniques, at least the techniques I'm critical about, are exploiting flaws in regulation,
Sure.
unintended consequences of regulation, exploiting extra knowledge about how software works, but when you actually look at it in terms of black or white, it almost looks like hacking.
Yeah.
Because
Yeah. Yeah.
it's one thing being very smart about how software works. It's another thing when you're just exploiting something that shouldn't even been there. And
Yeah.
there's lots of concrete examples I can't say online, but concrete examples of bugs that operating in exchanges that have been exploited. That
Yep, that circumvent rules that are built
yeah,
to circumvent rules. Totally understandable. So, like,
yeah.
for like, what is the deterministic factor of like, if the market is a good market for innovating and say in the higher frequency? Like, this is a topic that we have to deal with day to day. After looking at the stock market for a long time, we actually decided to not be in it. We did not want to get an automated trade there. Even in options, like it's pretty freaking hard as a quote unquote buy side, and that's why we looked at the futures. What's your general take on like for a startup that is semi-quantitative and also higher frequency, more technology oriented? What should they look for in order to jump into the markets?
Okay,
Especially
well,
global
in
market.
terms of this kind of interesting thing. Okay, a lot of these I'm going to say here are just kind of opinions based on being in the business. So don't take it as truth.
Sure, sure, yeah,
I'm sure there'll be people on Twitter who disagree with the things I'm going to say. But one thing is I see a huge difference between strategies that take liquidity and strategies that provide it.
Mhm.
And you'd think I would be against the taking strategies, but the reality is, if you're actually crossing the spread and giving up, fees and edge to put
Yeah,
on that position, first of all, you're challenging the market, and that's one thing ever from the beginning when I first met you guys, I was always impressed with Lucci's
taking.
ability, yeah, his ability to challenge the price in the market. And I think that's central to. Sorry about this thing here. I don't want to turn it off
No
here.
problem. No
Um,
problem.
it's central to price discovery in the market, to have traders that challenge the pricing of the market. And that's done primarily through taking.
Right.
Okay, it's also pretty difficult. There are some exceptions, some exploitation of regulation NMS, latency arbitrage. That it does involve some taking in a very precise kind of definition of that type of taking. But generally, taking strategies are not going to be
You're losing the spread, of course.
They're not exploiting.
Yeah, you're not exploiting. Yeah.
You're not exploiting the market structure. There's some exceptions, but they're actually a true, tend to correlate with true alpha and true innovation. And remember, the odds are kind of stacked up against those strategies because they're paying the cost of liquidity. And there's also, on top of that, I'm ranting here, but on top of that, there is a natural scale limitation. The market will only give so much liquidity at a certain price to these types of strategies. So I tend to be pretty impressed when people come up with strategies that scale well, that are along that line.
Sure.
I'd say those are the ones to invest in. What do you have going for you? The current market, many of the market maker or HFT firms that engage in the market refuse to take. And they've left kind of a void there for smart taking.
Sure.
Over time, we expect the edges that are unnatural in the market making space, which I've criticized in most of my material has been criticizing those. We don't have to talk about that, but we expect those to decline. And if you're trying to get into that space now, you're way too late.
Way too late. Got it. Okay. Well, Haim, I think from the Twitter activity, it looks like everybody's really enjoying this little wrap up of sell side, buy side. Really appreciate you hopping on, man.
All right.
It's always been a pleasure. Any last words for anybody here? Everybody's glad to see you, in the media here. So any last words? What are you thinking? What's the next step in life?
Yeah, I got a lot of stuff going on. I guess I'll advertise two things here. One, we're working on this platform. I've been pretty consistent with the progress. I guess we're going to give our first demo in May, but it's going to be an open source trading system. It's primarily for smaller entities, like you guys, to develop their own front ends, their own per trailhead data, connect up to different brokers, and it's entirely open source. So we'll be doing our first demo in May. I think the core backbone of this thing will probably be released this year, and it'll support quick fix, so there'll be that'll definitely be out there. Not sure about price feeds in the front end yet. That might be next year, but there'll be pieces out there, so letting everyone know about that. And the other thing, I've been doing a lot of really interesting work investigating edges that certain firms have over others that may not be definitely not ethical and are likely not legal. And and I've been working with insiders who don't want to interface directly with regulators but want this stuff shut down, who know a lot of detail. That business is growing very rapidly. And I want to basically encourage any insiders listening to this that at least giving me a call might be something.
A good idea.
Well, it'll be everything's confidential, and the way I think of it is, at this point, it's more of a hedge being on the right side of let's say history here.
Sure. Yeah, of course.
So give me a call if you. If you're part of, even if you're part of something, if you're someone who's willing to take that step to get it shut down, we can help and we can keep you confidential and anonymous.
There you go, guys. All right, Haim, thank you so much. Really glad to have you on the show, and let's make sure to catch up soon. All right, it's been too long here.
Okay, take care.
All right,
Thanks.
Have a good one. Bye now.